Welcome to the Property Couch, where each week you get to listen to two of Australia's leading property experts as they share with you the insider's guide to property investing.
All right, folks, here on the Property Couch, your insider's guide to property investing. I'm Bryce Holdaway, co-host of Location Australia on Foxtel's Lifestyle channel. And he's Ben Kingsley, the chair of the Property Investment Professionals of Australia and the 2014 and 15 Property Investment Advisor of the year. Hello, mate.
G'day, buddy. How you going?
Good, thank you.
That's
mate,
good.
Have you ever thought about when someone's being interviewed on radio, on telly, what's actually going on in the background? Because I recently got interviewed by Kevin Turner on his 4BC program it's 8:10 on a Saturday morning. So I said to my wife, radio interview, it'll go for 9 minutes. I'm just going out the front. So I've gone out the front, I'm on my mobile, I'm pacing up and down the sidewalk. The sidewalk? Am I American? The footpath.
The driveway, the footpath, yeah.
And chatting away to Kevin, and all of a sudden my 4-year-old runs out, Daddy. So of course you're in flow, so you're chatting. So it's kind of, and so all of a sudden he starts climbing up on the car, up on the roof, and here I am going, you know, I've got all these hand gestures for him to get down while still trying to concentrate. Then all of a sudden, my 2-year-old comes out, Where's Jack? And then he sees Jack up on the roof. So all of a sudden, he's climbing up. I'm thinking, oh my goodness, can my wife come out? And then all of a sudden, about 2 minutes later, she runs out. She's got this look on her face. I'm so sorry, I didn't even know they were out the front. And here I am. No one would be none the wiser. So anything like that over to you?
I've had a couple. The first one was on Your Money, Your Call on Sky News. We're just about to live show. We're just about to go to air. And one of the cameramen brings out our glasses of water and spills the glass of water with something like 28 seconds to go. And it's landed on my manila folder, which is blue. So all of a sudden, straight away, this water, and they're just scooping it off the desk. It's landed on my leg. Everything's starting to turn blue. The dye's coming out of it. And I've got to stand there and we're live. And he's sort of, cameras on Margaret, and I'm sort of on the side, and they're still scooping the water off the desk whilst I'm sitting there going, oh my God, I'm wringing wet. And then bang, it's like, and so how are you, Ben? Oh, lovely, thanks, Margaret. As my leg's got all this blue ink stain on it. That was my first one. And I also did a 4BC radio interview, and we'd won the Best Customer Service Award at the National Mortgage Broking Awards. So it was a big gig, and I said to Kevin, I gave him a warning. I said, look, if you want to get me on, I could have a late night if we win. And I did have a late night, and I'd lost my voice. So I'm halfway. So as the interview's going, we should try and get a recording of it. I'm just like, yes, so Kevin, it's been a great. And he goes, so at the end of it, he goes, so Ben, your voice is a little bit different. You obviously had tell us about what happened. Like, yes, Kevin, we won. He goes, well, that's good. So, give your business a plug. So he's like, Soothers. So that was quite interesting,
Yeah, it's funny you say that about Margaret, because I've been in that same studio and done it with Chris Gray.
Yeah.
And I remember the producers put my earpiece in. Do you remember this one, Ives? They put the earpiece in, they plugged me in. Then all of a sudden, I've decided to stand up with about 90 seconds to go before we're live to move my thing, and all of a sudden, the cord stuck, and you can imagine. Yeah. So they've all gone into a panic. Then all of a sudden, Chris has gone, mate, we're live in 20 seconds, and I'm going. So I'm trying to scramble, and they can't get it in. So basically, he's just had to go teleprompter, and all of a sudden, it's just thrown him, and we're live. And I remember because it was at 6:30, and then they repeated at 8:30, and at the end of the segment, we had to quickly do a new intro. And I noticed on the 8:30 segment, which is the one that my wife taped, that they'd actually
cut it all out.
But I thought, Chris, I'm so sorry, mate. Live television, and here I am as a Gumby trying to stand up just to move a folder. Anyway, we digress.
A bit of fun.
We digress. Hey, we thought we'd continue in our summer series and
do a Q&A.
Q&A.
Sounds good.
So, who should we rock paper scissors? Who wants to go first?
Oh, look, I can start.
All right.
This one's in from Alex. G'day guys. Aside from getting into property early and not selling, knowing what you know now, what 5 things would you have done differently? So we'll start with that one.
All right, let's split up the 5. I'll start it off. I wouldn't confuse activity with accomplishment. And I think what happens is because money's got a little bit of ego attached to it,
yep,
and a bit of adrenaline attached to it, I just thought I had some success on my first property investment, so I thought I was a legend.
Yep.
And effectively what I thought is I'd just try and be a property developer and just try to be a big wheel way too early.
Yep.
And I think in hindsight, looking back, if I had stuck to my knitting and done exactly what we've been talking about in the podcast for the last 40 odd weeks, that period of time wouldn't have been one of those periods where I look back and go, geez, I would have done things differently. So I always use the analogy of the rocking chair on stage. I could sit up there all day rocking back and forth, but I'm actually going nowhere.
Yep.
And I think that's the activity with accomplishment. I think people can be busy, going to seminars, doing a renovation, this course, that course, and then once they look back and see what they've done, it's so I've got some poor results in that period of time.
Yeah, look, and it's no secret that the first property I bought was across the road from mum and dad in a court in the northern suburbs of Melbourne. No idea what I was doing. It was an early purchase. I was 23, and so the first mistake is I had no idea, so I went with comfort, and that was the sort of first thing. And then the second part of that,
going with comfort.
I went with comfort. I went with familiarity. Sort of I knew what I knew about the area, and I thought every area and it's bricks and mortar, every property's a winner. And look, fortunately, it did do well. But then the second part of that, the next mistake came when I got advice to sell it because it had actually turned into a positively geared property, and I was living in Sydney at the time. So I got this advice from this so-called property guru who was a tax advisor and also a solicitor. No one of note, but he basically was all about selling or buying into off the plan, and sort of thought it was a good way to maximise your tax deductions, save on the stamp duty, all that classic type stuff. So I took his first bit of advice and I sold, and now that property would be almost over $600,000. Ouch. And I paid $120,000 for it, just to give you an idea. And then, but I did finally, I was reading the magazines, I was doing a lot of research and sort of building up my knowledge base. And so I didn't buy the off the plan. So I got to a stage where as much as I put $1,000 down on an off the plan in Zetlands, which is it was a growing part of the Sydney area at the time. And instead of that, I bought a single fronted house in Alexandria for $395, and it's worth over $1 million now. So
you poor man, that's a shocking investment. That one.
That one's been terrible. That one.
My next one, off the cuff, quickly, I'd probably say it's kind of an interesting mistake because I bought with someone else when I was 23, so that person actually gave me a leg up to get on.
Yep.
But it was actually probably in hindsight a mistake because you're joint and severably liable for the entire loan, even though I only had part ownership of the property. And it actually had impact on me trying to get my next property because the bank saw me as servicing the whole debt, even though I actually only owned half of it. So that probably, I don't know if that qualifies as a mistake because I got a leg up into the market, but it was something that if someone had a choice of, in safety, I want to buy with a friend, I would say to them, if you can do it on your own, buy together in the safety of friends in the same investment grade suburb. But probably, I see a lot of people say, we're just going to buy it together because it feels safe, but it actually has lending ramifications.
Yeah, look, and that's a good one. I mean, for me, the next one that sort of jumps into my head is the missed opportunity. So, as someone who analyses property, and I mean, what I know now compared to what I knew back then, there was a vacant block of land about, it would have been 300 metres from the beach in Western Australia. And my wife's Western Australian, so we spend every second summer over in the West.
That's why she's a great girl.
That's
West
why,
Australians
yeah,
are always
all those
with
Western Australians. Yep. They've got TV over there now, so sort of really moving on.
I think they've even got internet.
But
that's a shout out to the West Australians. I'm only serious.
Anyway, we obviously have a lot of fun between Western Australia and Victoria, and that goes on with my wife's parents as well. So it's a bit of fun. Anyway. This block of land I could put 4 townhouses on it, and I could pick it up for around $385,000, and then I didn't. So I just thought, no, scarcity land. Is it? My numbers were telling me it was a go, but my gut was telling me no. So it was a bit sort of conservative. Then the mining boom hit, and that land was then sold for over $1 million. So, there's one that got away. And there's, I think anyone who's been in the property game, It's probably got that one that got away, but that one was one.
If they don't, they haven't been in it long enough.
Yeah, that's right.
Okay, number 5. What would I say? The first property I bought was an apartment.
Yep.
In a large complex with a pool, a caretaker, and a lift.
Yeah. He's
What a
got
legend!
What about tennis court?
No, I didn't have a tennis.
Didn't
I
have
had one
that
across
much
the
land
road. So it was an investment grade suburb, but not an investment grade property.
Yep.
And therefore, here's the kicker. I think our loyal listeners has probably heard me say this before. I bought in the tower that didn't have the lift, and my body corporates had to pay for the maintenance of the lift. So there you go. That's a home run right there.
So well, look, and so the message is there, and that's why we do this podcast, is because if you're new to property investing, just listen to this and just avoid the mistakes that we've made and some of our listeners have made, and so they're the types of things. And then we've talked about podcasts. Episode 29 is a great example of that, common mistakes about property investors make. So and there will be more, and we'll talk more about some of the heartache and financial stress down the track that some people also experience when they get it wrong.
There you go, Alex. Thank you for that. Lewis Cook has asked, my girlfriend and I are currently living overseas, and we're podcast going overseas, mate.
Oh, lovely.
Want to move back to Australia in a number of years. We are 27 years old and want to start buying investment properties in 2016. We have 2 questions. 1, best advice for buying property without being able to walk through the property. And 2, best area to buy in Australia if you don't know where in Oz you want to move back to. Thanks, Lewis. Mate. You want to kick it off, me?
No, I'll let you one. You can get
best advice for property. Come on, get a buyer's agent. You're going to expect me to say that. Best advice for buying property without being able to walk through the property. I always say don't buy sight unseen.
Yeah.
If you, as the investor, have to buy something without seeing it yourself, you need to get a trusted buyer's agent in the middle of that transaction. So that's an obvious one for me, though.
Yeah, and it's not just a trusted one. I mean, get someone
Competent.
Yeah, investment competent.
Yes.
You talk about, investment savvy mortgage broker. There are plenty of buyers agents out there who specialise in owner-occupier and dabble in investment, but they've got no qualifications or no specialisation. So the reality there is, my tip is, absolutely you're going to need someone on the ground. Now, you might have a family friend who's been very successful in property investment, and if they follow the same principles that we're doing and they're really interested in helping, you two that are overseas, that could also be an option for you. But if you want to go the professional route and sort of limit your risk, then a buyer's agent will be the way to go.
Agreed. I think that sounds self-serving, so our listeners will probably see right through that. Number 2, best area to buy in Australia if you don't know where in Australia you want to move back to. That's really subjective. I travel around the country for location, Australia. All I can do is give you my opinion, and it depends on what your agenda is and what jobs you need and all that sort of stuff. But in terms of beautiful lifestyle locations, for me, Tasmania is my close second, but my number 1 without a shadow of a doubt is northern New South Wales. You're 15 minutes from the beach, you're 20 minutes from an international airport, and you're about an hour and 20 minutes from a capital city, so you can get acreage and rolling hills. But it depends on your lifestyle. If you need capital city job markets in terms of what you're doing, Lewis, well then it really depends on what type of industry you're in, really. Yeah,
it does, and in terms of, there's no doubt that there are different states and different towns are in different property cycles. So right now Sydney's still a no-go for us. Melbourne there's some opportunity in Melbourne, and then when we fly around, we're seeing opportunity in Brisbane, we're seeing opportunity in South Australia. Perth's a bit, sort of overdone. So, quick around the grounds. Canberra's an interesting one, usually fairly job reliable, good incomes. Actually, a lot of the beautiful amenity in Canberra around infrastructure.
It's actually surprising, Canberra, isn't it? You just think it's just
got
stuffy
everything.
Politicians, but it's not.
It's got everything. It's got a real, the livability score on Canberra, other than it's Canberra, is really good. We've got friends that we go and visit up there, and I think I've said that before. We went. It was a hot day. We went into this most amazing aquatic centre, and it was empty. Well, sort of very easy to get around. Whereas that same sort of aquatic centre in Melbourne, Sydney, you could barely put your towel down on the lawn. Yeah. So quite livable, and that's the sort of message. So it is going to come down, I think, to your career opportunities. If you're still quite young and you're looking to sort of build out your careers and leverage from the success you've had internationally, then I would suspect you would either be opting for Melbourne or Sydney
Yeah.
is most likely.
But if you're agnostic in terms of where you need to be, think about lifestyle. Because if you go to Sydney, you're going to pay $1 million for an average mortgage, and you're going to commute to work in the hustle and bustle. Whereas you go to Adelaide or Hobart or parts of Perth, where you can get a really great standard of living, still have opportunities to jobs. You may have a lower income, but lower living costs. So it all really depends on.
It's the pace of life, isn't it? I mean, in some cases, if you live in London, the pace of life is very quick. And New York and all those types of places. So if you come back and you're thinking, I want to have that slowdown, you go and buy that rural retreat, and all of a sudden you're like, oh God,
a bit too slow.
a bit too slow. So they're the other things you've got to think about. So I think it's good to sort of think about a 5-year plan as part of that process. So where do we see ourselves in 5 years? Do we look like we're going to have kids? Those types of things. So model out that sort of short-term story for yourselves, and that'll give you some of your answers.
Hopefully that's some gold for you there, Lewis.
Fantastic. Now here's one from Chris. It's a finance-related question. Hi guys, I've been listening to your podcast from the first podcast. You provided excellent information and resources. The question relating to turning an investment property into a PPR, principal place of residence. My partner and I just completed construction of a home which was intended to be an investment property for 5 to 7 years, after which time we were going to move in and make it our family home. Situations have changed, which are now able to complete paying off and moving into the property within the next 12 months.
Great.
Good on you guys.
Nice work. That's the secret.
Will there be any issues arising in regards to tax deductions, interest during the build, depreciation, since we'll be changing the purpose of the house? So this is obviously not a finance question, it's more of a tax question.
So here's some things that you need to talk to your accountant about.
Yes.
But it's all about the intention. So if it has an intention to act as an investment property, well then generally speaking the deductions are deductible against your income. So even if you're advertising for rent, not have a tenant in place, just advertising for rent, that's when the clock actually starts as an investment property. However, if the intention has changed for it to be a private or domestic purpose, well therefore the intent of the loan would have changed and therefore it's not deductible. But again, top line level staff can't answer it, you've got to talk to your accountant. But there's a few things to ask them to kick off.
Yeah, so I'll unpack that scenario. What I would be asking my accountant is, what is the benefit? So let's say if I'm moving in 12 months, so I'm not immediately moving in and I'm moving in 12 months. What if that property was to remain idle? In other words, it would be my PPOR and I'd pay it down and it remained idle versus, and then from that point of view, it is the PPOR, and then your circumstances change and you're able to let it out for a period of 6 months before you moved into it. But your intent was to have it as a principal home. That would be my first question to my accountant. Now, the substitution of that is, what if it was the intent has always been it's going to be an investment property and I rent it out for 6 to 12 months and then move in? Because the reality is there is a 6-year rule which says if my intent was to own it and move into it, and then my circumstances changed, which allowed me to move into it early, and then maybe in a couple of years move out and then rent it out, you would be able to get that
Principal place of residence exemption.
Yeah, the exemption and that 6-year rule component to that. So they're the questions I would be asking my accountant. So it's going to be an informed discussion around numbers. Obviously, you've had a financial windfall. That's going to change a few things in regards to that. So again, we stress, if you are looking for an accountant, make sure you look for accountants who have a really strong interest in property and property investment. So if this is new to you and you've been using H&R Block, and no disrespect to H&R Block at all, but if you're using someone like that and they specialise in just general tax and not necessarily specialise in property, then you want to basically look for that. So the first question I'd ask an accountant is, how many property investment clients do you look after? Do you own investment properties yourself? Because most accountants who own them themselves will know the tax that they can claim, and that's always a good starting point.
It's kind of our theme, is it? Investment savvy mortgage broker, an investment savvy buyer's agent. You need an investment savvy accountant.
Yeah, because there is definitely some interesting tax opportunities here that we can't give you advice on. So that's why, and we're talking in the thousands, not in the hundreds of dollars. So in the thousands of dollars. So modelling those two scenarios would be a good conversation to have with a professional provider.
Very good questions there. Thank you, Chris.
Thanks, Chris.
All right, Lou's written in. Hi, Boris and Ben, loving the podcast. Succinct and very informative, so thank you. I'm currently saving for my first investment property, and I have a couple of questions. I'm considering regional Victoria, as I grew up there, and was wondering how investment grade the properties are, particularly along the Victoria-New South Wales border. Should I be looking here or become more borderless in my approach? I'm looking to purchase in 2016, however I'm concerned with the property cycle. Should I hold off another year until the market drops, or is it likely to only increase in the short medium term? I understand you can only give general advice, but I'd like to know what the generally suspected trends are. Thanks again, Lou.
Ageing population, which means that there's going to be a lot of people who do look at moving up to the border community. So my parents retired up to Yarrawonga. We've got a lovely property up there that I love to frequent whenever I get a chance to and drop a line in the water. But the story of Yarrawonga and all of those border towns, Cobram, then you've got Wang, and then you go across to Albury and sort of Mildura, those types of areas. Now, here's the thing. Those people who are moving to those areas are usually retired type people, and their income potential is, well, their ability to buy the property is good because they're cashed up because they've got access to super potentially. But the reality is the job security for those others who are going to provide the services aren't big. You know, certainly health and wellbeing and sort of nursing homes, there'll be growth up there. But would I go into a town that had less than 15,000 people in it? So I'd probably discount areas like Yarrawonga and sort of Cobram and Echuca and all those types of areas. But I would look at Albury-Wodonga. I think Albury-Wodonga being that corridor through Canberra and Sydney, and with the ATO being there and Visy having some big infrastructure there, and La Trobe University having infrastructure there, says to me that it's on our watch list. That said, the supply side is what we would always, in the demand side, those mechanisms, and I've said this before, if a fast train was to get legs, Albury-Wodonga would explode. And, you know, so if you took a super long-term view, it would absolutely explode, because once you get over that Great Divide, the weather over there and the amenity, the Lake Hume, the golf courses, the access to, you know, the ski fields, it is all good. So it passes the lifestyle test. That's the message I have. So it's like not now, but again, you could probably pick an opportunity, pick the eyes out of it if you want to, but the reality is, on a general commentary, says we're not buying there at the moment, but it's always on our watch list.
Yeah, and in terms of tools so that you can do this on your own when you're doing any sort of destination, whether it's investment grade, is we always talk about economic activity, human interest, human behaviour, overlay those. And as Ben said, human interest, human behaviour, there's quite strong, but the economic activity is where you're going to get your job, what are the incomes going to be like, because we know that's what largely drives property performance. The other thing to think about when you're buying regional too, Ben, is what happens in the city doesn't always happen in the country, in terms of, you know, using Ballarat, for example. We've bought a fair bit of property there. Yep. You need a big shed and huge heaters, you know, and it doesn't really matter if it's walking distance to the train because everyone drives. Yeah. So you can't overlay city principles in the country.
That's right. So we've documented a lot of city principles that don't, you know, and some of the character home stuff doesn't necessarily stack up if there's lots of work on the property. You know, the tenants sometimes who are going to buy in those areas are going to want something that is low maintenance. That said, the character homes closer in to the established centres still go okay in the bigger regional centres, but that doesn't always work out.
Human behaviour.
Yeah, absolutely. It's still the status. It still lives.
Thank you, Lou.
So that's very good. And now I've got one from Christopher. Christopher says, "Hi, I'm a first-time investor and looking to buy an older Federation-era home. Good idea. For a three-bedroom home of this style, you are looking at a purchase price of around 550,000 mark. I'd love to know what city you're talking about. Due to an overinflation of newer homes, I can see these are the only worthwhile investments for future, as they generally are around 1,000 square metre blocks or less. Again, I'd love to know what you're talking about. And then a kilometre from the CBD and rising in value around 2 to 3% per year.
Kilometre from the CBD?
Kilometre from the CBD.
Wow.
Depending on the renovations that are performed, you know, where else could I get that type of return, or up to 10%? To find these funds, I'm looking at doing a joint venture with a good mate of mine who is a builder. Do the minor reservation God, here we go.
Now you're
Oh, yeah.
focused on it.
To find these funds, I'm looking at doing a joint venture with a good mate of mine, who is a builder, to do the minor reservation. It was like if you listen to the radio announcer yesterday with me, and he is a property investment analyzer, and she just went analyzer, and I just had to say analyst. So she was stumbling on it every time she mentioned my name. To find these funds, I'm looking to do a joint venture with a good mate of mine who is a builder. Do a minor renovation without over-capitalising it, holding it for maybe 5 years, rent it out for a period, and then sell it hopefully for a decent capital gain. Are joint ventures worth it? And will it be a silly strategy for such an old house as depreciation will have been used up already? And these older houses can be a Pandora's box once open and end up costing over budget.
Hey, that's
Box.
mate. Where can we get that? Purchase price 550,000 square metres, less than a K from the CBD. So what's the question?
So I think probably the questions we're looking at there is, it sounds to me, if you're going to get a character home in that area, that sounds terrific.
Yep.
You know, but if you're going to get something around that for that sort of price on 1,000 square metres, well, you've got some potential to subdivide the land off the back. So it really does come down to how big the city is he's talking about. And if that is the top end of the market, so remember, we don't like buying at the established bench price, we like buying around 10 to 15% of the median in that area, up to 20% either way of the median. So first and foremost, if you are looking at that type of thing, and if that's where the demand is, because he's right, new stock is always fairly easy to replicate. So if there's going to be an oversupply of new homes, but people, that human interest, human behaviour stuff around wanting to live in these old character homes also makes sense to me. And then finally, you know, the other part of the question is around joint venture.
Yeah. Well, I got a view. I've done a couple of partnerships, and they can put strain on friendships. So, just my advice on that is assume when you're starting the JV. This may be a little bit glass half empty, but you know,
It's all good.
Assume when you're starting the JV that you and your mate hate each other, and you're trying to unwind it. And what would you do in that scenario? Because if you start with that because it's always, oh mate, we're mates, and there's all these assumptions.
Oh yeah.
But it always gets down to I'm doing more work than you, and you're doing less work than me, and all that sort of stuff. So, but if there's an opportunity to JV and the numbers stack up, potentially yes. But what I'm seeing here is I'm a first-time investor, and then adding some complexity to it in a non-mainstream location. So to me, there might be. And then throwing a mateship into the mix. So can it be done? Yes. Renovating old properties, I always say that's great because you can't change the location, but you can change the property. So
absolutely, and there's some depreciation in something by doing that. But the JV for me is a story of having a financial buy-sell agreement. So a property joint venture agreement, and that needs to have things like minimum commitment times. So you've got to say we're in this for a minimum of 5 or 10 years. Okay, now you did mention in 5 years sell it, that's fine. And then what if the builder mate turns around and says, oh, you've got to pay me to do the reno work? You know, so you've got to flesh out all of these points. And then things change, you meet a girlfriend, you want to buy a home, and all of a sudden you want to get out of this in 2 or 3 years. That's the stuff we see. So it's almost like, so part of the other agreement that I'd absolutely be essential in there is to say first right of refusal. So first right of refusal means that I get the first opportunity to buy you out, and I'd have a clause in there that says at the price you paid. So that sort of makes them stickier to stay in the term of the agreement longer. So in other words, if you both kicked in $250,000 each, and the property's gone up by $100,000, that person who wants to exit out, bad luck. So you get that first right to buy your partner out of that purchase price. So that usually means they'll hang around because there's this handcuff in terms of growth that they're going to receive. So that usually, that type of agreement there just says to them, this is serious.
It's a marriage. Instead of until death do us part, it's until sale do us part.
Yeah.
Well, there you go, folks. Some great questions that we've just punched through. Hopefully that's been helpful to everyone in terms of our summer series for the Q&A. And as Ben does his scramble, as he does every week, to see where his sign-off sheet is. Just a reminder for folks, if you are sitting around having a bit of time with the family over the summer series and you haven't had a chance to read our book, we'd love for you to do that and for you to get get some thoughts on what that looks like. Also, if you go to social media, Twitter, Instagram, Facebook, there you'll find out first when any resources come out, when any new episodes come out. So we'd love you to be there as well. And Ivan Spence left the room. He's left me going. So I wonder if I can, at short notice, work out what sort of sign-off he's likely to do. It'll have some sort of French overtone, but mate, you might have to sign off in Bogan if you can't find your sheet.
I can't find my sheet.
Oh no, mate, you've let all our listeners know what our
obviously our
theory
preparation and professionalism here is fantastic.
Can't you tell?
Can't you tell?
Yeah.
Absolutely no idea where it is. So maybe I do sign off. Oh, here it is.
You mean just
under all the piece of papers right in front of me.
There we go.
Well, here, professional preparation. What are we doing here?
Doesn't matter, mate. We don't have any listeners left at this point.
No,
on the
probably
podcast.
not.
They've gone.
Estonian.
Estonian.
Oh man, yeah, check this out. Oh god. Hedaga.
Happy with that?
I have no idea.
No
Estonian,
idea?
Any of you Estonian?
Because we do go to
there?
Estonia, surely.
I'm sure we do.
There you go, folks.
Hedaga.
Head Agaya.
Okay.
Until next week.
I have no idea.
Head Agaya. See you, folks. Have a great summer. Cheers.
Bye.